Ladies and gentlemen, welcome back. It's another big week in markets, global markets, and I'm joined today by Peter McGuire. Peter, what's been happening? What's what? I mean, we're 2 days into a trading week here in Australia, 1 day elsewhere. The signals that are moving your world. Talk to me.
Well, good morning, Will. It's quite an interesting week because we've got 5 central banks meeting. And that really, I think, is demonstrating end of year, wind down into Christmas. You've got the big heavyweights being UK, US, Switzerland, Japan, and the Eurozone. So there's the storyline there, Will. 5 central banks meeting and all the action is underway.
Mate, so as you say, a mega week for central banks begins. Markets seem to be relieved after US inflation reports. Trading like this is it's fascinating. Dollars pulled back alongside yields. Stocks are closing at new records. As you say, it's a massive week ahead for the central banks. But if we look at America first, you know, we're talking about the US economy, its recovery. It's strong, but so is its inflation.
Absolutely. We saw the number released on Friday night, Will, at about 6.8%. But what the real shock to and that was year on year, that was November to November. What the shock was the Atlanta Fed, and they had the numbers as far as inflation over the last quarter, and it was just under 9% at 8.7. So where are we come February? Are we closer to that 8.5 to 9%? And could we be at double figures by Easter? So that really is a major impact, and how that's going to be absorbed to the market. So we're at 40-year highs. Does it stretch out to 50 or 60-year highs, Will?
Well, it's a good question. I mean, the other interesting overlay there is if we think about the inflation, the employment piece, we're talking about US workers. We're hearing stories, really, reports that US workers are quitting at a stunning pace in the search for better wages. Job openings seem to be near record. Are people getting the jobs? Are they getting the money? And can they afford it?
Yeah, well, there's even more to it than that. But yes, that's so true. So are they getting the pay packet? What is there? I mean, we've spoken on that while we're off air, as far as the habits of most office workers are now very much centric that they want to spend a day or two at home, and it makes their whole life far easier from that travel component that we all endure traveling into a city office. So people want those lifestyle choices and benefits that they've endured over the last 2 years not to actually be wound back, but probably be, you know, a 50 to 50 or maybe a 70-30 work week, Will.
So the work week may change, the working conditions may change, the employment contracts will need to change, and assuming what we're talking about here, Pete, is actually banking some of the learnings of managing remote workforces to deliver productive outputs and maintain the the general economic value of the product or service that actually is being sold. I mean, but it's an interesting space. I mean, the Great Resignation, Pete. I mean, have we seen this before in the history?
I put my mind back to probably over the 80s and the 90s with the technology booms, Will, and what we saw as far as the web-based era, that probably we have seen large parts of the market or the employment market move, but I don't think we've seen anything to this magnitude and the stickiness that seems to be unhinged from the worker. So, you know, they're far more remote based, they're far more transient in what they're after, and the other side, of course, is they're a longer working life, that your retirement age is probably now 70, and people are saying, well, due to economic forces, I'll be working till I'm 75 or 80, which isn't a bad thing, I suppose. It's as long as you're not, you know, laying bricks.
Well, there's that, you know, the active body, the active mind, you know, and I guess what we're talking about there is perhaps healthier economies in general. Obvious caveats apply right now. We're in the middle of a pandemic, so health is a relative thing. But you know, in general terms, you know, healthy body, healthy mind, healthy life.
Absolutely, they go hand in hand, and that's all about the longevity side and mobility. We've got something that we probably need to just touch quickly on as far as the dot plot this week, Will, the FOMC and what the Fed's prepared to do. We were looking at one rate rise, or in November, it was one rate rise in the States in 22, 3 in 23. Well, now they're saying they're going to wind that back, and they're all saying, well, it's going to be probably 3 in 2022. So there is the concern, and how quick is the taper pull off the table from they're thinking of doubling it from 15 to 30 billion. So it'll all be wiped out by March instead of June next year. So it's a quicker turnaround, quicker uptick as far as interest rate rises. And as I mentioned earlier, I know this is crazy, but you've got some economists saying it could be 5 rate rises next year in the States. So there's the story. That's the unsettling part. We've gone only a month and a half ago, we're going to have 1. Now people are saying you could have 5.
5 rate rises in a year. I mean, what is that going to do?
It'll push the dollar. It's currently at about 96.3, that US dollar index, Will, or I think it'll push it very, very close to that 99, maybe 100 mark. Has been 103, I think, in the last few years. So that gives us, I think, a true indication, because the other side is the UK and certainly the Eurozone won't be aggressive as far as rate rises. They've got a different situation over there as far as the COVID wind down and what's happening in Germany, and they've got civil unrest with France and Austria. So yeah, there's plenty of
action in Europe. That's
plenty of action.
If we look at that in Eurozone inflation, I mean, let's face it, it's already taken off, right? So you know, we're talking fragile recovery, muted wage growth, and so forth. But I mean, the chart on screen at the moment actually shows the Eurozone PPI rate going vertical. You know, it's literally from effectively, you know, well, not, I wouldn't say all-time lows, of course, but a -5 number up over a 20 number. I mean, that's a big movement.
Absolutely, and that's been it's just absorbed to the market. And also the other side, remembering as you've had inflation, you've also had those equity markets booming. So it's been a solid uptick. The Nikkei's been bid up strongly, the Japanese market. You've had the US markets, you know, Dow, S&P and NASDAQ. You've had the German DAX. You've had the French market. You've had certain other markets across Eurozone have been very, very strongly bid up. The UK FTSE market. So yeah, it's all been relatively strong, but will that continuation happen over the next year or two? That's where the jury's out a little bit.
Jury is out, Pete. Last chart for the day, we're talking about the euro dollar and how that reflects central bank divergence. What we're seeing here is a negative trend. I'm sure there's been a few trade opportunities on the way down. But here in November, sure, it's created a little bit. You know, we've seen a little bit of a bounce, but we're back at, you know, we're still running at pretty low numbers there, just over what 1.12, 1.13, maybe 1.14. And I think the comparison here is Euro USD and we're against the German and US 2-year bonds.
Yeah, exactly right. So there's very little chance we say that the Eurozone is going to be as aggressive as the Fed as far as raising rates. So that will put further pressure as far as a downside to the euro versus US dollar. US dollar will be probably bid up, Will, to that, as I mentioned, 97, 98, 99, may hit the magic 100. And what happens as far as euro, I think that you'll possibly take a 109 out, maybe a 108. Who could imagine? You know, will it ever happen? Will, you'll see parity as far as €1, $1. Who's to know?
Well, who's to know? But there's the signal, there's the opportunity, there's the reason why we continue to stay in touch with the marketplace. Pete McGuire, thanks very much. Look forward to wrapping up with you again next week.
Look forward to it, Will, and it'll be a Christmas special. Thank you, Will.